You know that the very first railroad line was opened almost 200 years ago in 1836? Let's start. Hello everyone, Alex is here. I hope you're doing well. I hope you're staying safe as always. And I really hope that you're ready to go on the ride with me today. Choo choo! So stupid. Today we're going to be looking at industrial sector and what are the best dividend stocks there. And there is something very interesting going on there between the very two largest industrial stocks that we're going to touch on today. And before doing that, I just want to go through some intros first on what is this industrial sector, what is going on there, what are the stocks out there, what they do, and how to look at them, and why these stocks actually, this sector is the easiest one to predict and to look for the companies, the good companies, and to understand what's happening with them. So industrialization actually generates employment opportunities, provides educational opportunities, encourages advancement and innovation, and also better utilizes resources. All of these benefits and more of those make industrial development extremely valuable to our population and also to our local economies. Industrial stocks are actually part of one of the long-lived sectors in Canada and also around the globe. And these stocks represent companies that developed into something more, something bigger than just cotton mills. Because the companies of today's industrial sector are actually focusing on one of the 5 main areas, such as machinery, manufacturing, construction, healthcare, and defense and aerospace. Moreover, industrial stocks are actually on the second place in number of stocks on Dividend Aristocrat list, only behind our best and the biggest financial sector. And why this sector is actually very interesting for investors? There are a couple of things for that. First, it's easy to read. So it means that the stocks are actually very easy to understand what's happening because they follow basically the economic growth of the country. Therefore, where the economy is booming, these are the stocks you want to be in. But when the economy is going down, these are the stocks that you want to sell. Never sell. Keep holding. And this correlation between different economy cycles actually helps investors to understand when it's a good buying opportunity and when it's time to sell. And a good example is last year, when the market crash happened because of this pandemic situation, the first stocks that everyone started to sell, if they started to sell, were industrial sector, because they knew the economy is gonna just plummet all the way down. And after that, when the vaccination started to happen, and we realized the economy is gonna coming back very, very soon, the first sector you will start adding to your portfolio would be industrial sector, because you expect the economy to come back and the industrial sector is going to follow its growth. The second point is that industrial sector is actually poised for growth. What it means that the companies in this sector are actually going to be growing more and more over a long-term period, alongside with the economy of the country. The third point we have here is the long history. What it means that the companies in this sector are actually one of the oldest companies on the stock market. And it helps us to understand what was happening during different economic conditions, what is the average growth over a long-term period and whatnot, so you can sort of predict the future and what to expect from these stocks. The fourth point here is that the industrial sector companies almost always pay dividends. And on top of that, they also keep increasing their dividends consistently. No wonder they're part of the Dividend Aristocrat list, and they're on the second place there in terms of number of stocks. I also have a video where I go over the best Dividend Aristocrat companies on TSX. You can check it out the video here. And it's not always sunny with this industrial sector. There are actually a couple downsides you want to keep in mind. And the first downside is actually controversial to one of our advantages, which is economic dependent, which means that it's easy to read these companies we just talked about, right? So you can understand what's happening based on the economic conditions in the country, but on the other side, they're very dependent on these economic conditions. So definitely you need to diversify these stocks with some other sectors as well. The second downside is that the companies in the industrial sector have low dividends, which is true, but they also consistently increase those dividends, so overall returns potentially can be better, but the dividends itself, if you invest for a short-term period, are pretty low. And the final disadvantage for them is actually political risk, which means that the sector can benefit from different political decisions, but they can also take another turn if the decisions are made against them. So you definitely want to keep that in mind. And today I want to cover the largest railroad stocks on TSX. And it's also happening this way that these two stocks are actually going through some battle in terms of acquiring other companies, and they'll keep fighting against each other who is going to actually acquire them or not. And the first one is Canadian Pacific Railway. The ticker symbol is CP.TO. This railway started to emerge all the way back in the late 19th century. The first railroad they built was connecting the Eastern Canada and British Columbia in 1881 to 1885. The company also went through some acquisitions already. They acquired a couple of Canadian companies in 2009, and right now they're also targeting a Kansas City railroad and want to acquire them as well. And this potential acquisition between Canadian Pacific and Kansas City Southern is going to create the first US-Mexico-Canada rail network, connecting ports on the US Gulf, Atlantic and Pacific coasts, and offering single line hauls across the continent. The shares of Canadian Pacific exploded crazy high over the last couple of years, with the company seeing shares up 53% in the last year and 754% in the last decade. So they were basically generating a return of 24% annually over the last 12 years. And besides that, their dividend grew by 13% annually over the same time period. What has also just happened to Canadian Pacific, they just did a stock split 5-to-1. What it means that if you had a single share of Canadian Pacific, now you have 5 shares with the same overall value, of course. But also what it means is that it is easier for all the future investors to invest in this stock. Instead of paying $500 per share, now you would pay around 95, I think, the share price right now, which is pretty cool for all the potential future investors because the entrance is easier. Now let's take a look what we have from our metrics for Canadian Pacific. Their market cap right now is around $59 billion. Their current dividend yield is around 0.76%. So yeah, you can see this is not the best dividend yield out there, and it's probably not the best stock for passive income investors. I understand you, so you definitely want to keep that in mind. Their dividend growth rate is actually pretty good. They've been increasing their dividends consistently for the last 5 years. And their payout ratio is also pretty consistent. Well, they're not paying a lot of dividends, so it should be. It's actually at around 20%. What is important for this stock is actually their growth. Over the last 10 years, their share price appreciated by 670%. So this is huge. The company is growing year over year consistently, and that's very important for investors to see this consistent growth. Their beta parameter is at 0.72, which means that the share price is not very volatile over the short-term period, but also you need to keep in mind that the company is going through this acquisition nonsense right now. So depending on the news, where they go, who's going to acquire what and why, the share price is going to fluctuate based on that. But again, this is a short-term period. Over the long-term period, I think the stock should grow no matter what. Now let's look at the other railway before we jump into the battle between them. So the next one is the Canadian National Railway. The ticker symbol is CNR.TO. And this company is actually the largest Canada's railway system in terms of both revenue and physical size of the rail network. The railway is spanning across Canada from Atlantic coast of Nova Scotia all the way to Pacific coast in British Columbia. And that's approximately 20,000 miles of railroad. Canadian National Railway also went through acquisitions of a couple of American companies, so they have a presence in the US as well. And looking at a couple of recent updates for this stock, you can see that over the last month or two, the stock actually dropped significantly a couple of times when the news were announced where Canadian Pacific is going to start its acquisition of Kansas City. And that's when actually Canada National Railway started to tap into this acquisition talks and also placed their bid to acquire Kansas City. So the whole battle started, and it's super nonsense what's happening there. Nobody knows what's going to happen, what's going to be the end result, unless it's already done. But as of recording of this video, it's still in progress. But one thing I find very important of all this negotiation, all this acquisition nonsense that's happening, that no matter what's going to happen, no matter who's gonna acquire what and why. Both of these stocks are super legit, they're valid, they're gonna grow over time no matter what. And of course, you can risk it and place your bet who's gonna win this acquisition, and you will win probably on the short-term period, but over the long-term period, both of the stocks gonna grow no matter what. Both of the companies went through acquisitions before, and as you can see today, they're still growing significantly like crazy year over year. And besides that, for Canadian National Railway actually, because they had this couple significant drops over the last month, I think right now they're actually super undervalued. The company is in a strong buy mode, and I think also they're gonna drop even more. That's why I'm investing in a dollar cost averaging every single week. So I don't know when the drop is gonna stop, but it's gonna stop at some point, and then the company is gonna start growing back. Let's take a look what we have here from Canadian National Railway from our metrics. Their current market cap is around $92 billion. So as you can see, this company is actually almost 2x bigger than Canadian Pacific. Their current dividend yield is around 1.89%. Their 5-year average dividend yield is actually at 1.66%. So as you can see, even from these numbers, you can tell that the stock is undervalued. So right now, as I said, is a very good buying opportunity for that. What is also important that this company been increasing their dividends consistently for the last 25 years. So they're very good dividend aristocrat. They keep increasing their dividends year over year, and I have this feeling they're gonna keep doing this going forward. Their payout ratio is actually very stable at 47%. Over the last 10 years, this company actually grew by 270%, so the number is not that crazy as for Canadian Pacific, but you still can see this consistent growth year over year. Their beta parameter at 0.623, so similar to Canadian Pacific, you shouldn't expect a lot of volatility over the short term, but again, because of all these acquisition talks, you might see the share price fluctuation more than usual. So depending what you're doing and what is your investment strategy, for myself specifically, I consider both of these stocks are very good investment opportunities over the long-term period. I keep investing more into both of these companies week over week. So as I said, I'm using this dollar cost averaging approach. I don't want to predict the market and what's going to happen because of this acquisition talks. I just want to make sure this company is going to succeed long term. So both of the stocks we talked about today, Canadian Pacific and Canadian National Railway, are more of a growth stocks rather than dividend stocks, but they're also part of the dividend aristocrat list, so they keep increasing their dividends every single year. And if you think you can invest and hold these companies over the long-term period, you will definitely benefit from all these dividend increases year over year. There are also 3 more industrial stocks that I think might be interesting for you. The first one is the largest printing company in Canada, Transcontinental. The other one is the Waste Connections. And the third one is Finning International, which is right now a very undervalued stock, in my opinion. With all that, thank you for watching here. Let me know in the comments what you think about these 2 railway companies and the battle they're going through, and all the other industrial stocks you're investing into or you are watching right now. Thank you for watching. Don't forget to smash that like button, subscribe to my channel, hit the bell. I'll see you around. Stay safe. All the best there. Thanks. Bye.